everyone. Welcome to this week's Wealth Wednesday. We're going to be talking all about Obamacare and how you can navigate Obamacare and set up your income to make sure that you minimize healthcare costs as much as possible. I hope everyone had an awesome Christmas. I know my wife and I did, spending some time with families. Obviously, this year it's a little different, a little crazy, but nonetheless, we had an awesome Christmas. Let me know if you guys can hear me. I want to make sure everything's going well on the tech side of things. So if you could just comment below, let me know that you can see me, you can hear me. That would be fantastic. I'm going to go ahead here and share my screen. And then spotlight it. Oh, I think this is spotlighting. One sec. Oh, no, I think I got it. All right. Perfect. Want to make sure you guys can still see my face, though. Sorry, 1 second, guys. It looks like they updated the software a little bit, I think. Oh, well, this will work. Perfect. All right. So let's go ahead and get started. Okay, so we're going to be talking, like I said, all about navigating Obamacare and how you can save thousands per year by building your income around Obamacare subsidies. Okay, and this can get a little complex, but hopefully after this Wealth Wednesday, it's going to get a lot more clear. So we've shared this graph before, but there's really three phases of healthcare costs that you will face throughout retirement. Okay, in the red zone here, that's what we're going to be talking about today, Obamacare versus continuance insurance. The middle part, once you turn 65, the majority of you will be on Medicare. That will last for the majority of your retirement. And then towards the end, if you end up in a nursing home or have long-term care, obviously that can get a little bit expensive. Now, notice here, we're going to be focusing on this red part today. And notice here that there's a dollar sign and then there's $3 signs. And that's because Obamacare, depending on how you set up your income, can either be very affordable or it can rise in cost and cost quite a bit. So we're going to teach you how to make sure that you're on the left side of that, making sure you minimize costs, making sure they're affordable for your retirement. Okay, so options before 65. There are really two options. Some of you may only have one option. There's either a continuance of healthcare from your work, okay, and that might be available, might not. Typically speaking, while you're working, your company is heavily subsidizing your insurance. They're paying for quite a bit of your insurance. Now, some retirees have the option to continue that into retirement. However, now they are forced to foot the bill. So when we talk about continuance from work, now, the good part is you get to keep the insurance that you've been on, keep the providers that you've been with. The bad part is it's typically quite expensive. It's not uncommon to see $1,000 per month premiums per person. Okay. On the flip side, you have the public marketplace that the Affordable Care Act created, otherwise known as Obamacare. And so how do you make the right decision for your retirement? Okay. Well, there's kind of three questions that you should ask. First off, is continuance through your work available? Okay, and if it is, at what cost? Okay, will your employer continue to, your past employer continue to subsidize it at all, or will you now have to foot the entire premium bill? Okay, number two is, how is your current health and your need for health care? Okay, someone that's in great health condition and hasn't gone to the doctor in a while might choose to pick a plan, whether through continuance through work or through Obamacare, that it's a very low cost monthly plan, but on the back end, they might have a little bit more cost sharing. On the other side, on the flip side of things, if you're someone who has some pre-existing health conditions and you know you're going to be in and out of the doctor going forward, it may make a little bit more sense to pay a little bit higher premium per month. The trade-off there would obviously be that you don't have that same cost sharing on the back end. So you pay it more upfront, but then more of your healthcare costs are covered on the back end. And then number 3, this is the really important one when we talk about Obamacare. How controllable is your income? Okay, because as we'll get into it, your cost for health insurance on Obamacare is going to come down to what income you report to the government. And so can you control that income? Or is that income through pension income, or if you've already turned on Social Security, are you forced to take income that you really don't have any avenues? Might make more sense than to take a continuance through work. But we're going to dive into each of these a little bit further. So very broadly speaking, I'm not going to get into the different plans that are available on Obamacare. I'm going to stay very bird's eye view and talk about how you can integrate it from a cost perspective into your retirement. So broadly speaking, there are 4 levels of protection with Obamacare. And it's pretty straightforward: bronze, silver, gold, platinum. Like you would guess, a bronze plan is typically cheaper, but has more cost sharing on the back end. So might have a higher deductible on the back end as you go up. So for instance, let's say a gold or a platinum will be more expensive on the front end, but obviously have less cost sharing on the back end. General enrollment for Obamacare is this last year was November 1st through December 15th. Okay, then coverage starts. So if you enroll between the 1st and the 15th, coverage would then begin January 1st. Now, if you retire mid-year, a special enrollment period opens up for you. Now, the critical thing with Obamacare that might surprise some people is your costs are tied directly to your income. Okay, so depending on what your income is, what you report to government, the government will actually give you a subsidy for your health insurance. So the lower we can report your income to the government, the higher your subsidy. And you'll see that this subsidy can vary widely. Okay, on the lowest end, subsidy might be well over $1,000, almost $1,500 per month. Where on the high end, if you don't get that subsidy and you take a silver plan that's $1,300 a month, you will be paying that full $1,300 per month per person. So we're going to dive a little bit more into this. So how will you know if you qualify for a subsidy? Well, there are 2 things that determine this. Okay, the first is your household size. So is it just you, or are you single, or do you have a spouse? Obviously, if it's you and you're single, that's a 1-person household. If you have a spouse, that's a 2-person household. And the second thing is your modified adjusted gross income. Now, this is a weird number that we're going to show. It's different than your taxable income. It's different than your adjusted gross income. Okay, for your healthcare modified adjusted gross income is a weird calculation, and it includes some things that might surprise you that we'll talk about. But basically, based on this, you can see on the right side of the screen, we have the household size, and then we have the maximum amount that you can show for income and still get a subsidy. And so basically what this is based off of, if you're below 400% of the federal poverty level, you can qualify for a subsidy. So basically what they do is they take a household size for 1 person, they increase it by 400%, which in this case for 2021 would be $51,040. If your income is less than that, you qualify for an Obamacare subsidy, which will lower your healthcare costs. Now, it's important to note that we recently recorded a webinar on Medicare. And so Medicare, when they're determining your premium, they look back at your income 2 years prior. It's important to note that for Obamacare, they only look at that current year. So for 2021, if you're going on to Obamacare in 2021, basically when you sign up for your plan, you'll report an income number to the government. Okay, then it's basically what you expect your income to be. And then at the end of 2021, they look at the income, what you actually took for income, and that you'll either have to pay back some of that subsidy or you'll get to keep your subsidy if you were correct. And so the important thing here is the year of 2021 matters for what subsidy you will get in 2021. Okay, so what is this modified adjusted gross income number for healthcare? Well, it includes some things that might surprise you. So wages and distributions is pretty simple. So if you're working part-time at a job, you make $20,000, obviously your modified adjusted gross income is $20,000. The big one that surprises people is untaxed Social Security benefit. So regardless of how much tax you owe on your benefit, your entire benefit amount will be included in this number. Okay, so if you're taking $20,000 from Social Security, once again, you have a $20,000 modified adjusted gross income that gets added in. Pension and annuity income, capital gains, any passive rental income, unemployment benefits, and then another big one that we'll discuss a little bit more is interest. So let's say you have a $100,000 CD at 1%. That's kicking out $1,000 of interest. Well, that will be added in to this modified adjusted gross income number. Now, again, we're going to dive a little bit deeper into this in a sec, but there are a few ways to reduce your modified adjusted gross income. None of them necessarily help you. Basically, let me step back for a second. Your goal with this modified adjusted gross income is to take the income that you need. So let's say you need $50,000 a year. Now, at that point, your subsidy would start phasing out a little bit, but your goal will be to take the income you need while reporting a lower income to the government. Okay, so there are some ways to reduce your modified adjusted gross income, but none of them really help you take the income you need while reporting less. So for instance, some of these ways are qualified plan deductions. So basically, if you contribute to an IRA, or a SEP or a simple in a given year, that will lower your modified adjusted gross income. So let's say you initially have $50,000, you contribute $5,000 to an IRA. Well, that will lower your modified adjusted gross income to $45,000. Now, the reason I say that's not really helping you that much is because if you need to live off $50,000, well, contributing $5,000 to an IRA doesn't allow you to live off $50,000, right? HSA deduction, same thing. If you contribute to an HSA, it will lower your modified adjusted gross income. But again, that's money that you can't use to live off of. Ones that won't really apply to probably anybody in this group, student loan interest is deductible, and then alimony payment as well. You can deduct from that modified adjusted gross income. But what I want to do is I want to jump into an important distinction here and show you the difference between taxable income and healthcare modified adjusted gross income, because these are two totally different numbers. And as we jump into this example, I think this is going to become very clear. So let me jump to the whiteboard. Let's just give you kind of a quick hypothetical scenario. Let's say that you're a retiree that needs to live off $60,000. Okay, and you've already filed for Social Security, which is going to be $40,000, and which means you're taking $20,000 from your IRAs. Okay, so when we're talking about your taxable income, okay, basically what we would do is we would take this $20,000 of IRA. Okay, that's taxable income treated as ordinary income. And so we add that in there, and you have $20,000, okay, of taxable income so far. Now, the way that Social Security is taxed, we've covered it in past videos, so I won't cover it again here. But it's taxed in a weird way that only a small percentage of your benefit will be taxed. In this case, based on $40,000 of Social Security benefit, only $4,000 of your benefit will move into your taxable income. Okay, now pretty simple math here. 20,000 plus 4,000 is 24,000. Now we still have the standard deduction. So let's assume this is a married couple. Standard deduction being 24,800 here, and they're owing zero in taxes. So despite taking $60,000 of income, they don't have a tax liability here. Now you would look at that and say, okay, so I'm guessing after the standard deduction, they don't have basically any taxable income, any tax liability. Won't that be the same for your modified adjusted gross income? And the answer is no. Okay, and this is one thing that it confused me early on, and I think confuses a lot of different people. So if we look at your modified adjusted gross income for healthcare purposes, you take that same $20,000, because again, that's ordinary income. But then remember, your Social Security benefit, even untaxed benefit, is included in full. And so we have to add in that full $40,000. Our modified adjusted gross income for Obamacare purposes is $60,000. Now, at that point, we're starting to see our subsidy fade out. And so even though we're not owing any taxes over here, we're still showing $60,000 of income in terms of Obamacare's income number, okay? And so, again, this is confusing, but just know that these are two completely distinct numbers. Your standard deduction does not help you for your modified adjusted gross income. So as we jump into this, this is kind of just an illustrative way to look at this subsidy. On the bottom here, you can see your modified adjusted gross income. On the side here, you can see basically an annual premium. And what I want to show here is, let's see if I can grab my marker here. So as we see from $20,000 modified adjusted gross income over to a little bit above 60, and I just grabbed this for illustrative purposes. I think this is a few years old, but as you can see here, as we ramp up our income, we can see that our premium, our subsidy basically fades away. And we can see kind of, it's pretty linear in the fact that for every dollar we make, we see our subsidy go away at a similar rate. But notice what happens here at 400% of that federal poverty level. Sorry. We see that there is a cliff here. Okay, and we call this the healthcare cliff. Basically, if you're planning around Obamacare and trying to keep your income low, you need to make sure you're below this 400% cliff, because once you drop off that cliff, if you make $1 more, your premium jumps up, as you can see here. Okay, and basically you go from having a subsidy to basically losing a giant part of that subsidy. And so we need to make sure that we're planning very carefully around this part of the modified adjusted gross income and subsidy level, okay? So what are a few strategies that we can use to keep our income artificially low, but still live off the income that we need? And so I've got a little quote here. You don't need to live in poverty. You just need the government to think you do. And so this is kind of where the beauty of planning comes, because if we're careful about it, we can still, whether you need $50,000, $80,000, or $100,000 a year to live off of, if we have the time to plan for it and strategies are available, we can basically create your income where you're living off $100,000, but you're reporting far less and therefore getting a subsidy. So how can we do that? Well, the first way is with keeping income in cash reserves. So basically plan before you need the income. Okay, basically the worst thing that you can do is, let's say you're retiring at 62. Well, a couple months before leading up to 62, the worst thing you can do is start planning for Obamacare. You simply leave behind most of your options. And so we want to plan well in advance, and we'll show why in a sec. But I want you to start viewing the loss of a healthcare subsidy as an additional tax. Okay, so basically if you pass over that 400% poverty level, you have to pay extra for healthcare. Well, that's essentially just like a tax, because you're making a couple dollars more, and all of a sudden you have an additional cost that's being added into your balance sheet, into your budget. And so start looking at this healthcare subsidy as an additional tax. Now, it might make sense to withdraw from IRAs while you're still working, keep it in a cash account, and then use that money in those early years of retirement. So let me give you an example. So we have Lisa. Lisa's 64, 63 last year, obviously. Now, last year she was working, and while she was working, she was in the top of the 22% tax bracket. Now, she's single, and she needs to live off $52,000. So she's going to be on Obamacare for 1 year. So we really only need to plan this situation for 1 year. Well, what would have made a lot of sense is if you have money in cash, okay, if you have income in cash, you've already paid taxes on that money. So you can take that money out, take it as income. And so let's say you needed $52,000. Okay. You can take $20,000 from your IRA. Okay, at $20,000, you would receive a significant subsidy. And then if you have a cash account, let's say you had $60,000 in cash, well, you could take that $32,000 from cash. Okay, so 20 plus 32 equals 52. And because you've already paid taxes on that cash, on that money in cash, you take that money out, live on it. You don't have to report that for modified adjusted gross income. So for Lisa's situation, while she was still working at 63, we had her take $22,000 from her IRA and put it into cash. Okay, so she then, in the year she was retired at 64, she took $30,000 from her IRA, and then she already had $22,000 sitting in cash. So that, again, she equals that 52,000. But most people would say, why would you take $22,000 out of your IRA when you're in that higher tax bracket? Well, you're still working. Well, if we just quickly calculate this out, $22,000 and 22% is $4,840. Hopefully you guys can see that on the screen. So she's paying almost $5,000 extra in taxes. Well, here's the interesting thing. If she is at $30,000 of adjusted gross income, her healthcare costs are $120 a month. Okay. If her modified adjusted gross income is $52,000, her monthly healthcare costs are $1,100 a month. Okay. So if we take 1,100 minus 120, that's $980. $980 for the year is an extra $11,760. So basically, she's in a situation where if she's at $30,000 of modified adjusted gross income, $120 a month at $52,000, she's at $1,100. Let me erase that. She's at $1,100 a month. And so the gap here is $980. And so she's paying 48. I think that was, whoops. Let's try this again. 40, I think it was $48.50 in taxes this year in order to save, what was that? $11,760 in healthcare costs the following year. And so we can see how withdrawing money from your IRAs while you're still working and keeping them in cash can create basically a cash reserve that we can use once we're forced onto Obamacare and forced to keep our income low. Okay, so that's one quick strategy. Another big one is a taxable account. So a taxable account, if you have a large taxable account, near perfectly. And then end of the year in interest that pushes you over that 400% limit. And all of a sudden that $3,000 of extra interest costs you $12,000 or $2,000 in lost subsidy, whatever it might be. Okay, so generally we want to keep those out of a taxable account because they're going to force you to be taxed. The other thing we want is for you to drop mutual funds for the same reason. Mutual funds, you can't control the taxes. Okay, so they might spit out a capital gain at the end of the year and you really don't have, there's nothing you can do about it. The mutual fund has a good year, spits out a capital gain. If it's a $5,000 capital gain, it just threw your healthcare situation. It just flushed it down the drain. So make sure you're holding those in other accounts. It's much better to hold ETFs rather than mutual funds. The critical thing here is only the capital gains from the taxable account will count in the modified adjusted gross equation. So for example, we have Nancy and Carrie here. They have a $250,000 taxable account and they have about $50,000 of unrealized gains in that account. Now they're going to be on Obamacare for 3 years. So what can Nancy and Carrie do? Well, I said at the beginning of this that the taxable account's kind of a golden goose. Let me show you why. So if we go over the whiteboard once again, let's just scroll down so we have a fresh whiteboard. Let's look at their situation. So they have $250,000 in their account. And of that, $50,000 is unrealized gains. So if they sell anything in that account, it's going to move capital gains into their taxable income, into their modified adjusted gross income. But notice here that basically for every dollar they sell, they have, for every dollar that they sell, it's only going to move 20 cents into their modified adjusted gross income. Why is that? Well, they sell $1. Their cost basis is basically their cost basis is 80%. Their unrealized gains are about 20% of the account. So every dollar that they sell, they're going to have 80 cents of cost basis essentially, and 20 cents of unrealized gains. So when they sell, they can basically sell. Okay, let's say they need $50,000 of income. So they take $50,000 from their taxable account, sell it as income. Basically, what that's going to do is it's going to move $10,000 into their modified adjusted gross income. Well, look at this situation right here. We can easily see how they can easily fill their income they need while keeping that modified adjusted gross income down. Okay, so this is why a taxable account can be so powerful, because it only moves a fraction of the gain into your modified adjusted gross income. They've already paid taxes on the $200,000. All they have left to pay taxes on that will move into that modified adjusted gross income is just the unrealized gains. Okay, and so funding the income, funding the lifestyle that they need won't be hard because they have such a large taxable account. Okay, another simple, pretty straightforward one are Roth IRAs. So when you put money into a Roth, you pay taxes. When you put money in, you can then take that money out completely tax-free. So it's pretty simple to see. They are excluded from healthcare modified adjusted gross income. So if you took, you could take, if you have $1 million Roth IRA, you could take $1 million in a given year. That's not included in that modified adjusted gross income. Important to know, if you are planning on using Roth conversions to convert for Obamacare purposes, remember the 5-year rule. So let's say that you're planning on converting from an IRA to a Roth IRA because you want to use those Roth assets next year to keep your income low. When you do a conversion, it starts a 5-year clock that you can't take that money out of that converted Roth for 5 years. And so this is why it's so important to plan ahead of time. You want to do Roth conversions 5 years before you need them, essentially, because basically you can't touch them otherwise. And then finally, another kind of cool idea is selling a home or a property. So is anybody in this group planning on downsizing in retirement? Funds from downsizing are likely not included in modified adjusted gross income. Where they would be is if you had a huge capital gain, a taxable gain from selling that home. Well, how you get around that is downsize while you're still working and not on Obamacare. And basically what this can do is, essentially act as a cash account. So for instance, we have Carrie and Gary. Okay, they own a house and a cottage. Both are going to be paid off by retirement. Their plan is to sell their house and move up to their cottage. At that point, they will start on Obamacare. Well, they're essentially selling that house that they have all this equity. Let's say it's $200,000 worth of equity. Well, that equity, when they sell that house, will basically be cash. Well, they can use that as a cash account in the same way they could if they had a $200,000 checking account. So if they need to spend a few years in Obamacare, they can take a little bit from their IRAs, keep that healthcare subsidy large, and take the rest of the income they need from that sale of that house. Okay. So again, if you're planning on downsizing, there are some strategic ways you might be able to use that money from selling a home or selling another property. A few common mistakes that we see. One we've kind of touched on a little bit is waiting until you retire to plan for Obamacare. As you can see, some of the strategies that we've talked about to keep your modified adjusted gross income low, they take some time. They take some planning. It's not easy to build up a big taxable account in a year. It's not easy to build up a big Roth account in a year. This stuff needs to be planned ahead of time. Okay, a huge mistake that we see is filing for Social Security before 65 and going on Obamacare. The reason being is because you are receiving a penalty in so many different ways. First off, as we showed earlier, even untaxed benefits are included in the modified adjusted gross income. So if you get $1 from Social Security, it's going to count as $1 against your health care. Okay. Second reason is, as we covered in this group before, if you file for Social Security early, you receive a penalty. Okay. That penalty is a lower benefit. That penalty is over the long term, you're going to have less tax preference money coming from Social Security. You're going to have less of your income inflation adjusted. And so filing before 65, especially when you're going on Obamacare, can be a huge mistake and can hit you in more ways than one. Another big one is taxable account mistakes. So time and time again, we see a lot of people with CDs, with bonds, and mutual funds in that taxable account. And towards the end of the year, they finally see why it can be some mistake, because when they get that 1099 on their taxable account and it shows that they had $4,000 in extra interest that wasn't factored into that Obamacare number, all of a sudden they're going to have to start paying back that subsidy, and that can be a hard pill to swallow. So make sure you are optimizing that taxable account, not holding mutual funds, not holding bonds or CDs. Okay. So kind of in summary, know your health options before you retire and between retirement and 65. Oftentimes, Obamacare can be considerably cheaper. That's not always the case, especially if you can't control your income as much. But for the vast majority of us that haven't filed for Social Security and don't have large pensions, a lot of times you're able to control and keep that income low and therefore save thousands of dollars a month on your healthcare costs. Your income will determine your costs almost entirely. So if we can hold that is obviously, you can see the cost savings we've talked about. And then there are strategies to show a lower income while living off a higher income. Again, you don't need to live in poverty in order to receive the subsidy as if you were. Okay, you can keep your income higher. The important thing is basically working around the government loophole. Okay, using income that isn't counted towards modified adjusted gross income, keeping that subsidy high. The big thing here is plan before you're faced with making a decision. Okay, hopefully this was educational. Hopefully it gave you guys some additional confidence when entering into this healthcare situation. Anything with the government, we always say it is complex, complicated, as you can see, the weird way that they calculate out your income. But as we go through this presentation, you don't need more money. Okay? You just need a better plan. You need a plan that gives you a large subsidy from Obamacare, minimizes those healthcare costs. Hopefully this was educational. If you have any questions, I can't really see those questions now and answer them live, unfortunately, but I'll make sure that I'm afterwards answering any questions that you guys have. Have a great new year, everyone. Stay safe out there. Thanks.